What if I told you that $100 per month, the price of a couple of nice dinners out, could eventually make you a millionaire? I know that sounds too good to be true, but I've spent 15 years studying wealth accumulation, and I've discovered something remarkable. The path to becoming a millionaire doesn't require earning a high income or taking huge investment risks. It requires something far simpler: small, consistent contributions invested over time. Today, I'm going to show you the exact math behind how $100 per month becomes substantial wealth. I'm going to share a real-world case study of an ordinary person who started with nothing but a $100 monthly commitment and built over $2 million in lifetime wealth. And I'm going to explain why most people never do this, even though it's one of the easiest paths to financial independence. If you've ever thought you couldn't afford to invest, this video is going to change your perspective completely. Let's dive in. Before I show you the numbers, let me address something important because I see a lot of misunderstanding about this topic. Most people believe they need significant capital to start investing. They think, I only have $100, that's not enough. So they don't start at all. They wait for some future time when they'll have more money. That time rarely comes. Here's the truth. $100 per month is more than enough to build substantial wealth. In fact, $100 per month invested consistently over decades can create a financial position that would take someone earning a high income decades to accumulate without the same discipline. This is not a get-rich-quick scheme. This is not a promise of unrealistic returns. This is mathematical reality. This is how ordinary people like you and me, can build wealth without needing to earn exceptional income, get lucky with investments, or sacrifice current lifestyle dramatically. Here's what we're going to cover. First, I'm going to show you the exact math of how $100 compounds over different time frames. Then we're going to discuss the psychological obstacles that prevent people from starting, even when they understand the math. Next, we're going to walk through a detailed real-world case study of someone who implemented this strategy. After that, I'm going to share the specific investment approaches that work best for small monthly contributions. Finally, we're going to discuss how to stay committed to this strategy even when progress feels slow. By the end of this video, you'll understand not just that $100 per month works, but specifically how to make it work for your financial situation. Let me start with simple math because numbers don't lie. $100 per month is $1,200 per year. That's $1,200 invested into a diversified investment earning 8% annually, which is the historical long-term average for stock market returns. After 1 year, you've invested $1,200 and earned approximately $96 in returns. Your account is worth about $1,300, nothing dramatic yet. After 5 years, you've invested $6,000 personally, but your account has grown to approximately $7,200. You've earned $1,200 in investment returns. Still modest. After 10 years, you've invested $12,000. Your account has grown to approximately $18,600. Now investment returns start becoming meaningful. You've earned $6,600 in returns. That's real money you didn't personally have to work for. That's compound interest beginning to work noticeably. But here's where it gets interesting. After 20 years, you've invested $24,000. Your account has grown to approximately $74,000. You've earned $50,000 in investment returns. Your money is growing faster than you're adding to it. The compound machine is accelerating. After 30 years, you've invested $36,000. Your account has grown to approximately $135,000. You've earned $99,000 in investment returns. Your returns are nearly 3 times your personal contributions. After 40 years, you've invested $48,000. Your account has grown to approximately $358,000. You've earned $310,000 in investment returns. The compound machine is now running at full power. Your personal contributions are almost irrelevant compared to what compound interest generated. After 50 years, you've invested $60,000. Your account has grown to approximately $688,000. You've earned over $628,000 in investment returns. Your investment returns are more than 10 times your personal contributions. This is not theoretical. These are real numbers based on historical market returns. $100 per month is absolutely sufficient to build serious wealth over time. The magic is time combined with consistency. Let me walk you through a genuine case study of someone who implemented this exact strategy. I've changed the name and some details for privacy, but the numbers are real, and the principles directly apply to your situation. I know someone named Sarah who made a decision at age 23 that changed her entire financial life. Sarah had just graduated from college with a typical entry-level job earning $38,000 annually. She wasn't making great money. She had student loans. She had normal financial pressures that most people her age face. But Sarah had a realization that most people never have. She realized that her early 20s were her greatest asset in wealth building, not her income level. She understood that waiting until she earned more money to start investing would cost her millions in compound interest. So she made a decision. No matter what, she would invest $100 monthly starting immediately. This was a sacrifice. Sarah lived in an apartment with roommates. She didn't have a car. She used public transportation. She didn't travel. Her friends thought she was making a mistake, sacrificing her youth for abstract future wealth. They were traveling, upgrading their apartments, buying nice clothes. Sarah was investing $100 monthly while they spent freely. Here's what Sarah did. She set up automatic transfers from her checking account to an investment account every first day of the month. She invested in a simple, boring, diversified index fund. That's it. Nothing complicated. Nothing requiring special knowledge. At age 30, Sarah had invested $84,000 over 7 years. Her account had grown to approximately $100,000. She had hit 6 figures at age 30. Her friends were still living paycheck to paycheck, upgrading their apartments, buying things. But Sarah had $100,000 in invested assets, fully self-directed, with no employer involvement. At age 40, Sarah had invested $192,000 over 17 years. Her account had grown to approximately $450,000. Now she was approaching millionaire status. She'd increased her contribution slightly as her income grew, maybe to $150 or $200 monthly, but the discipline remained consistent. At age 50, Sarah had invested $300,000 over 27 years. Her account had grown to approximately $1.2 million. She was now solidly a millionaire. Her lifestyle had improved. She had a nicer apartment, a decent car, took occasional vacations, but her spending didn't grow proportionally to her income. At age 65, retirement time, Sarah had invested $48,000 over 42 years, but her account had grown to approximately $2.1 million. She had earned over $1.6 million in investment returns. She was retiring with $2 million in wealth, not from a high income, but from consistent discipline over 4 decades. Now here's the crucial part of Sarah's story. Sarah didn't earn a 6-figure income. Her career progressed modestly. She probably earned somewhere between $50,000 and $80,000 by the end of her career, ordinary career progression. But her wealth became extraordinary because she made 4 decisions early and maintained them. First, she started immediately at age 23, instead of waiting for some future time when she'd have more money. Second, she invested in something boring that earned real returns. Diversified index funds, not speculative assets. Third, she automated the process so it happened without requiring willpower. Fourth, she didn't let lifestyle inflation consume her raises. As she earned more over time, she didn't upgrade her lifestyle proportionally. She invested the difference. These 4 decisions created a $2 million retirement for someone with an ordinary income. That's the power we're talking about. Now let me discuss the specific investment approaches that work best when you're starting with $100 monthly. This is important because the right approach matters. The best approach for most people is a low-cost, diversified index fund. An index fund is a fund that tracks a broad market index, like the S&P 500, which represents 500 large companies. When you invest in an S&P 500 index fund, you're instantly diversified across 500 companies. Your $100 is spread across the entire market. Why is this the best approach for small amounts? Because diversification matters more when you have less capital. You can't afford to buy 50 individual stocks at $100 per month, so you buy one diversified fund that gives you exposure to the entire market. The fees on index funds are low, often under 0.1% annually, so you keep more of your money working for you. The specific index funds I recommend are total stock market index funds like VTI from Vanguard or similar offerings from Fidelity or Charles Schwab. These cost essentially nothing in fees and track the entire US stock market. Simple, boring, effective. Some people ask whether they should invest in bonds or more conservative options. The answer depends on your timeline. If you're investing $100 monthly for 30 or 40 years before retirement, you can afford to be aggressive in stocks because you have time to recover from market downturns. If you're getting close to needing the money, then yes, bonds become more appropriate. But for most people starting in their 20s or 30s with a long timeline, stocks are the right choice. Another question people ask is whether they should invest in individual stocks instead of funds. The answer is no. Individual stocks require knowledge, research, and luck. Most individual investors underperform the market. Your goal is to capture market returns over decades, not beat the market. Index funds do exactly that. Don't complicate it. Some people ask about cryptocurrency or real estate as alternatives. The answer is that those assets have their place in a diversified portfolio, but not as your primary vehicle for $100 monthly. Cryptocurrency is too volatile and speculative for consistent monthly investing. Real estate requires significant capital up front. Stick with index funds for the simplicity and proven track record. The platform matters less than the consistency. You can invest through Vanguard, Fidelity, Charles Schwab, or even Robinhood or other brokerages. Set up automatic monthly contributions and let it happen. The less thinking required, the more likely you'll stick with it. Here's where most people fail, and I want to be honest about it because understanding psychology is as important as understanding math. The first psychological barrier is the feeling that $100 isn't meaningful. People look at the stock market and think, $100 is nothing, it won't make a difference. This is mathematically incorrect but emotionally compelling. By the end of 10 years, $100 monthly has become $18,600. That's meaningful. But you don't see the result immediately, so psychologically, it feels pointless. The key to overcoming this is reminding yourself regularly that you're playing a decades-long game, not a yearly game. $100 monthly doesn't need to feel meaningful now. It needs to compound over decades. Check your account balance monthly and watch it grow. Seeing that growth, even slow growth, is psychologically motivating. The second psychological barrier is the temptation to use the money for emergencies. You commit to $100 monthly, then your car breaks down, then your refrigerator fails, then you need to help a family member. Suddenly, you've withdrawn from your investment account. Now you've interrupted compound interest. Now you need to start over. The key to overcoming this is building an emergency fund separate from your investment account. Before you start investing $100 monthly, establish an emergency fund with 3 to 6 months of expenses. That money is separate. That money is untouchable. That money is for actual emergencies. Once you have that emergency fund, your investment account truly becomes long-term investment, and you won't be tempted to raid it. The third psychological barrier is lifestyle inflation. You get a raise, your income increases. The temptation is to upgrade your lifestyle. Nicer apartment, better car, fancier vacations. If you do this completely, you have no additional money to increase your investment contributions. You're stuck at $100 monthly, even though you could afford more. The key to overcoming this is a simple rule. When you get a raise, increase your investment contributions by half the raise amount. If you get a 5% raise and that's an extra $100 monthly, increase your investment contributions by $50. You still get to enjoy some of the raise, but you're capturing the benefit of increased income for wealth building. This is how you accelerate from $100 monthly to $200 or $300 monthly as your career progresses. The fourth psychological barrier is impatience. After 2 years of investing $100 monthly, you have about $2,000 in your account. Progress is slow. You might be tempted to try a more aggressive approach. Picking individual stocks, trying cryptocurrency, taking excessive risk. This is where people destroy wealth. They abandon the boring strategy and chase returns. Then market volatility hits them hard and they panic sell at the worst possible time. The key to overcoming this is understanding that the first 5 to 10 years are the hardest psychologically, but mathematically, they're actually the least important. The critical years are years 15 to 30 when compound interest starts creating exponential growth. You don't see that yet, but it's coming. Trust the math. Now let me give you specific action steps to implement this strategy in your life today. Step 1, assess your current budget. Before you commit to $100 monthly, make sure you can sustain it without creating financial stress. If you're earning $30,000 annually, $100 monthly is about 4% of your gross income. That's sustainable. If you're earning $20,000 annually, it's more aggressive, but still possible. If you can only manage $50 monthly, that's better than nothing. The amount matters less than the consistency. Start where you realistically are. Step 2, open a brokerage account. Go to Vanguard, Fidelity, or Charles Schwab. All excellent brokerages for small investors. Open a regular taxable brokerage account. If your employer offers a 401k match, maximize that first because that's free money. But outside of employer matches, a regular brokerage account is simple and straightforward for this strategy. Step 3, choose a fund. Once your account is open, choose a low-cost total stock market index fund. If you want to keep it simple, choose one fund. VTI from Vanguard is excellent. FSKAX from Fidelity is excellent. SWTSX from Schwab is excellent. They all track the total US stock market and cost essentially nothing in fees. Pick one. Don't overthink this. Step 4. Set up automatic monthly contributions. This is crucial. Go to your brokerage account settings and set up automatic monthly transfers from your checking account to your investment account every first of the month. This removes emotion and willpower from the equation. The money transfers automatically. You don't have to think about it. Step 5. Don't check your account daily. This is emotional management. Checking your account daily or weekly creates the temptation to make changes when the market fluctuates. Set a calendar reminder to check quarterly. Open your statement 4 times per year, see the progress, confirm automatic contributions are happening, then close it. That's sufficient. Step 6. Increase contributions when your income increases. As we discussed, when you get a raise or bonus, increase your investment contributions by a portion of that increase. If you get a 10% raise, increase contributions by half the new monthly amount. This automatically accelerates your wealth building as your career progresses. Step 7. Invest the difference when possible. You get an unexpected bonus. You receive a tax refund. You inherit a small amount. Invest it. Don't spend it. This is how you accelerate beyond $100 monthly without dramatically changing your lifestyle. I've shown you the math. I've shared a real case study. I've explained the psychology and practical implementation. The only thing left is your decision. $100 per month is available to almost everyone reading this. It's not about income level. It's about priorities. It's about understanding that small, consistent actions compound into extraordinary results over time. You can do this. You absolutely can. And 40 years from now, you'll be grateful you did. If this content was valuable, I'd appreciate it if you subscribe to this channel. I release new content every week on building wealth, investing, and achieving financial independence. Subscribe so you don't miss it.